Okay, Dan Fitzpatrick here, stockmarketmentor.com. And first, before I get to Rocket Labs, which is what I want to talk about here, I want to invite you to join Stock Market Mentor. It's a $7 initiation fee. It's 2 free weeks other than your $7. And just today, I taught almost a 2 hour class, mostly devoted to R multiples and risk, and why that's a hell of a lot more important than just looking at what your average gain is, your average percent gain is on a trade. A lot of people, most people, I think, measure their performance in that way. Hey, what's my average gain? In percentage wise, but you're not talking about risk. You're not thinking about risk. And anybody who's been trading for any length of time knows that risk is more important than just percentage gain or loss. And how can I tell you for sure that those who have been trading for a long period of time understand that? Easy. Because if you don't understand that, you're not going to trade for very long. So anyway, I want you to check that out. Again, if you're not a member, $7 for 14 days. You know what? If you don't like it, you can email Karen at stockmarketmentor.com and we'll refund you your $7. All right. That's all I got for you. All right. I want to get right to it and look at Rocket Labs. I'll share my screen here. Okay. So this is the deal with this stock, just with the chart. I can see this is a really, really strong setup here. I don't think it's too late. I don't think it's too late to buy the stock here, but I want to explain it. First of all, if you're using Investors Business Dailies, if you're using their approach, then this is really where you're going to be looking to buy is on this next pivot here. This is forming a low kind of a cup, really. I can't really say it's a handle because I sure as heck don't see one, but you can see the stock pulling back left side, bottom side here is a base, classic shakeout. By the way, if you sold here, if you got shaken out, don't feel bad. That's why they call it a shakeout. It's what happens to people. Here it breaks down below support, like really key support, fell down on about average volume, and that's kind of your first indication that maybe this isn't a real end of an uptrend. I'll go ahead. I hadn't planned on doing this, but I'll go through it. So here, stocks trading sideways looks like about 67, $66 is pretty nice support here. You can see the 200-day moving average close to breaking out above the 50. Love it. That's what I want. That's where I want to buy the stock right here when it breaks out above the 50. This is going to be great. Not so much, oh crap, I bought the stock early. Now I'm selling because I don't want to lose my butt. And so then the stock comes down. You're not thinking about the 200-day moving average. You're thinking about having bought here at 73. And now the stock's down 21%. And you're trying to figure out what to do other than go get some toilet paper and clean up back there because this was a big, big dump really, really fast. All right. So this is a shakeout now. We realize this is the shakeout on this sell-off down here. Here, we don't know. You don't know whether it's a shakeout. This could be a truck stop on the way to $30. So here we get confirmation that there's a shakeout. Volume heavier than average, still well below where we thought, okay, we'll buy this stock. But now we have a different risk reward profile. Now we can buy here 64 and change. And if it's true that this was indeed a shakeout, we can even set our stop just below this day, which is the 31st of March, below this day's intraday low of 59.03. That gives you what, an 8.5% risk, which is a lot, which is why you'd start with a smaller position. But the idea is, and I'm not even talking about the 200-day moving average, because if you want to put it back there, that's 12, 13%, which you can do. But remember what I said at the outset here about risk, about how risk is more important than percentage. So here, you're taking a smaller amount of risk by just putting your stop down here, below this day's intraday low. You could even raise it a little bit more and say, well, if it falls back to 60, I sure expect it to hold. So if it falls to 59, that's when I'm going to take the L and get out of town here. So that's a 7% risk you're taking on this trade. And your basis for taking this is because you have concluded, rightly or wrongly at this point, that this is a shakeout. In other words, this is institutional selling trying to flush out supply, which they've done, and now they're snagging the stock. So you set a tighter stop here. Now you're a happy boy or girl. Stock's moving up, higher intraday highs, keeps going up. You're really happy now. Suddenly, the 7%, you took your risk here of about, we'll say 8%. No, we'll say 7%. Let's say 8. I'm debating with myself. You took an 8% risk. Now, at this point, you're up 6.35%. At the high here on this day, you're up 14, almost 15%. So you got a heck of a trade going on very, very low risk because this stock is so volatile. Typically, an 8 or 9% risk is a huge amount of risk to take to start. But with a volatile stock like this, the way you start a position with a reasonable stop is with a small position size. You're putting less money at risk. And then once the stock starts telling you, yes, you're correct, that's when you start building a big position. So you have a small risk to begin with in this trade. So the stock is still working, still rewarding you for buying on this day, right at the end of the day with this risk. Now you're up 12%. Again, you took an 8% risk. So you're up over 1R multiple. Now suddenly you're up a whole gang of money here. Now you're up 28%, having taken an 8% risk. Up 20, taking 8, that's pretty good. Now we're up even more. You're buying right here at the end of the day, taking 8% risk. Now you're up 38, 39%. We'll say 40%. So now what are you going to do? Well, if I'm you, I'm happy. Assuming you're doing this trade, you can protect this trade by keeping a stop. I wouldn't keep it below today's intraday low because you know what? Sometimes after this kind of move, the stock can get a little jiggy, but I would definitely not want to allow it to trade below this low, below Friday's intraday low. So this is really where I'd put my stop on this. Now, what about buying this stock right now? If you're looking at the Investor's Business Daily or Bill O'Neill style, you would say, well, the next pivot point is actually right up here. So I'm not going to really buy the stock till it gets up to 98 bucks or so, almost to 200 bucks. That's the classic breakout. That doesn't work for me. I'm not saying that I know better than Bill O'Neill. Only a fool would say that, and I'm not one of those. But I'm just saying that this doesn't suit my trading style to wait until it gets up here, particularly with this kind of move, because I'll move this out of the way from the 200-day moving average. For this to finally get up to where it's a breakout, that's a 73% return. Like that's a 73% move before you're going to look at this and say, oh, I'm going to go ahead and buy this stock on a breakout. Now, it'll probably work because stocks that make all-time highs tend not to make just one of them. They'll make a bunch of them in a row. This is why we love all-time highs, or at least stocks that are within, say, 15% of their all-time highs. They have a little bit of ceiling, but then ultimately when they hit an all-time high, like I said, they'll hit a bunch of them in a row. So we can wait for this here, but this is what I choose to do. Remember how I said if you're in a trade like this, you want to protect your position with a stop just below the prior day's intraday low. Okay, well, guess what? You can do that with new positions too. You can protect your stop excuse me, you can protect your position with a stop that's about 6.6% below the current price. So let's say 7%. So you're taking a 7% risk, which means that if the stock runs up to 95.50, you've got a 1R return, meaning you're making a buck for every buck that you're risking. We want at least 2Rs. So we need 14%. Okay. Now we're up 12. Now we're up 14. So we've cracked the $100 level, which is a hard ceiling, and we've gone a little bit beyond that. And now we've got a 2R trade. So do I think that we can get that trade? Absolutely, I do. But I'm more concerned about the risk. So with taking this amount of risk, I'm comfortable looking for this type of return because guess what? As the stock moves up, if it does, it may not, as the stock moves up, I can start raising my stop so that I actually have less risk on the table as the stock moves higher. So, look, this is the kind of thing that I explain at Stock Market Mentor all the time. Today was I gave this a yeoman's treatment of this idea of risk multiples, R multiples being the absolute way that you stay in the game long enough to figure everything out. Okay. Also, watch for this 7 deadly trading mistakes and how to fix them. I'm just in the final proofing right now. It's taken a lot longer than I thought because we're making sure that we get everything right. I want you to be there. Get on the website. Top banner on top tells you how you can grab one of these books. Okay. That's all I got for you guys. I hope you are having an awesome week so far. It's only Monday. Okay, you got 80% to go. Let's make it an awesome 80%. All right, I'll see you guys.